Hi everybody, I hope you're doing well. Today we're going to tackle some questions around saving for retirement, specifically the traditional versus Roth question and how IRAs work a little bit. I'll just start off with a disclaimer. As always, this is not investment advice. This isn't even personalized tax advice. So if you'd like to know how this applies to your situation, please reach out to your financial team, your financial advisor, and your tax advisor. They're happy to work together to help you get the best result. That said, let's jump into it. For retirement planning, you're probably most familiar with the 401k, 403b plans that you have through your employer. Those are a great first place to start, especially as employers are generally matching those contributions up to a certain level. So we would always recommend maximizing the employer match first. Those plans also generally allow you to put over $20,000 a year into them. So you generally don't need other options unless you are in a position to put more aside. The next option is IRAs, which we're talking about today. And then if you're self-employed, you have the option to do a solo 401k or a SEP IRA or a simple IRA, and we will talk about those in another video. So for today, talking about IRAs. IRAs are something that you set up individually on your own with a financial institution. You can put up to $6,500 into an IRA for 2023. You have until April 15th of 2024 to contribute for 2023. You can put any combination of funds into a traditional IRA versus a Roth IRA. So you could put $3,000 into one, $3,500 into the other, with some limitations. If you're over 50, you get an additional $1,000 that you can put aside. So the rub here is that Roth IRA contributions can only be made if your income is under a certain level. So if you're under about $130,000 and single, or if you're under about $204,000 and married filing jointly, you can contribute to your Roth. If your income's over that, you're not allowed to contribute to the Roth. You can contribute to a traditional IRA regardless of what your income level is, but there are some limitations that make that contribution either deductible or not deductible. So with that Roth income limitation, we would always say that if your income is close, if it's possible that you might not be eligible to contribute to that Roth, that we would recommend waiting until tax time to fund that Roth for the prior year. So if your income was too high, and if you don't have any other traditional IRAs, there is the possibility to do a backdoor Roth, which sounds a little silly. With a backdoor Roth, you contribute to a traditional IRA and then you turn around and immediately convert it to a Roth. That only works if there are no other tax-deferred IRA accounts. So you don't have a traditional IRA, you haven't rolled over a previous 401k into a rollover IRA. As long as you don't have any other accounts like that, you can fund your Roth this way. Why would you want to do the Roth versus the traditional? They both have their pros and cons. With the Roth, the contributions aren't deductible, so you don't get any benefit this year on this tax return for putting money into a Roth. Whereas the traditional, you do get a deduction for it at this time and at your current tax rate. With the Roth, your earnings grow tax-free. You never pay tax on those earnings as long as you hold it into retirement. Whereas the traditional IRA, when you pull those monies out in retirement, they're entirely taxable. You're not paying tax on the earnings over the years, but when you retire, every dollar that comes out is taxable. With the Roth, you can pull money out tax-free early. So the money that you put in can come back out without a tax consequence, which is nice. With the Roth, you never have to take the money out. You can leave it in there and pass it on to your heirs. You never have to take the money out. With a traditional IRA, once you hit age 73, you have to start taking annual distributions out of that account with the end goal of having it fully distributed over your lifetime. In the end, we would recommend having a balance. In retirement, you're still able to take your standard deduction, you're still able to take advantage of the lowest tax brackets. And while tax laws change, we never know exactly what they're going to look like, 10, 20 years from now. But in general, the theory is that for a single person, for instance, your standard deduction is almost $13,000. The 10% tax bracket is for the next $10,000 or so. So if you were retired today and you took $23,000 out of a traditional IRA in retirement, and that was your only income, your tax bill would be about $1,000, which is about 4%, which is much less than it would have been the tax benefit that you got for putting the money in the first place. For the next, $80,000 or so, you can take more money out at 12%. Which is still probably lower than what it was when you earned it and put it in the traditional IRA in the first place, or the traditional 401k. So Social Security benefits do make this really rough calculation more complicated. So definitely see an advisor for your particular situation. But you want to be able to fill up those lowest tax brackets with taxable income like a traditional 401k, traditional IRA, and then fill the rest with money from Roth accounts and money from non-retirement investment accounts. That balance will serve you best in retirement. Let us know if you have any questions. If there are any things that we can tackle in future videos or anything we can follow up on, definitely let us know. Enjoy your week, and we'll see you again next week. Bye.